Welcome to the FarrCast, providing you insight into Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. Today is the 20th day of February. 20th day of February. Folks, if you keep count on things like these months, there are another 8 days left in this month, just over a week, and month 2 of 2025 is over. It's over. And I always like saying it's over because the great story, this is an Insider Washington story. Chris Matthews was a great friend. He went after Tip O'Neill was retired. Tip O'Neill flew to Washington. Chris still went to pick him up. And O'Neill gets in the car, Tip O'Neill, and he's all grumpy, ladies and gentlemen. He's all grumpy. And Chris says, everything okay? And the former speaker says, you know, they let me on the plane there early. And there was this really cute, very attractive young lady flight attendant. And she was helping me in my seat to get my seat belt around me. And she was just cute. And I was delighted. And she looked at me and she said, you know, sir, I shouldn't tell you this. I'm not supposed to say anything, but there's supposed to be someone very important on this flight. So keep your eyes open. He said, can you imagine? He said, listen to me. When it's over, it's over. And so, folks, we're coming to the over of February anyway here. Lots of things are over. One of the things that is not over, ladies and gentlemen, is this market's rally. Stocks made a new high, new closing high on the S&P 500 again this week. For everybody who's telling you it's overvalued, they're not wrong, but excess can continue. 22 times earnings is not cheap, but that doesn't mean it can't go higher. And a lot of the earnings are still coming out okay, though the forecasts are not so okay. People are showing concerns. Walmart's earnings said that they're concerned about what happens with tariffs, pressures on prices in the stores. They don't know what's going to happen. The Fed minutes yesterday released showed that the Fed governors are concerned about tariffs. They're not sure how they're going to impact the economy. Inflation seems to be very slowly moving in the right direction, which is lower. The rate of increase is lower. The Fed seems to think they've got it under control, but it's sort of like, hey, Katie bar the door. We don't know what happens if 25%, 50%, whatever these tariff increases are, they could change all the math and we might have to change position. That's just logical, folks. So we've got uncertainty. We've got a president and an administration now that likes bombastic, shocking remarks. They have been effective in many situations. A lot of people really don't like them. Frankly, I really don't like them. But you gotta say, okay, look, in certain cases, they work. In certain cases, they work. And President Trump is getting a lot done. And if you don't like what he's getting done, well, too bad, number one. But he is doing pretty much everything he said he was going to do. Everything he said he was going to do, he seems to be trying to do. So, like it or not, that's what I'm seeing. Okay, 10-year Treasury's hanging in at 451. Watch the 10-year Treasury. If you want to talk to Kenny Polcari, Jim Uriel, any of the experts we have, Stephanie Link, Jenny Harrington, anybody we have, Bryn Talkington, on the FarrCast, the one thing they're going to tell you they watch every day closely is the yield on the 10-year Treasury and what's going on in the bond market. So 451, that's kind of hanging in. That you're seeing a 7% 30-year mortgage is unusually high. It should be 6.5%. 200 basis points is the spread typically between a 10-year and the 30-year. So those rates are still high. Mortgage applications falling, home sales not doing great. That market's very slow. And stocks, as I said, are continuing to do okay. What does it all mean at this early point in the year? And the president's approval ratings are starting to drop a bit slowly. What does it all mean? Kenny Polcari, Chief Market Strategist at Slate Stone, CEO at Case Capital Advisors. Kenny, welcome back to the FarrCast.
Michael, thank you for having me. It's always a pleasure to be on with you.
It's always a pleasure to have you. And
I don't want this to be over yet.
No, we can't be over. We're not over. We're not over for about another 10 minutes. In another 10 minutes, we're over. Okay, I have. But now that you said it, you brought me back. So one more Tip O'Neill story. I'm great friends with Marvin Bush, the president's youngest son or youngest brother, depending which President Bush you're talking about. And Marvin tells the story of playing golf with his dad and Tip O'Neill after both were out of office. And Tip O'Neill has about a 6-foot putt, and he's shuffling over, he says, shuffling, almost dragging his feet across the green, and looks like he's going to pick up the putt. And President Bush looks at him and says, hey, Tip, what you doing? and O'Neill looks at him and said, I thought that was good. Hey, Tip, why don't you putt it? And so Tips shuffles back off across the green to the golf cart and passes Marvin and stops him and looks him dead in the eye and says, when I was speaker, I didn't even carry a putter. Speaker of the House, putt's always good, Mr. Speaker. That's good, Mr. Speaker. All right. Kenny, it was just great Washington stories. If you're a Washingtonian, you hang around these people. You live in California, you hang around the movie stars. I don't know.
But your Boston accent there with Tip O'Neill was very good.
Was that okay? Okay. Well, you're the expert on the Boston accent, so I'm working on it.
Yes.
All right. Tell me what's going on. Markets are good. We've got disruptions politically, and markets seem okay. How do you see this?
The markets are so resilient. The whole tariff drama and the end of the world is coming and the market's going to crash. Clearly, investors are not buying it, right? They're not getting panicked over tariffs. They understand where they're going. They understand how they're being used. They can see the results. They see these other countries coming to the table to have a conversation. Let's talk about this before it gets out of hand. And I think that's a positive. I think the market. Appreciates that. I also think the market is becoming. They're reconciling the fact that, in fact, the Fed is going to remain on hold, that the Fed is not going to cut rates. And I think it's okay with that, right? And the bond, like you started this whole conversation about the 10-year bond, the 10-year bond is stuck between this 4.25, 4.75 trading range, right? Which is where we've seen it. We're not really breaking out, but it's not really breaking down either. So we're smack right in the middle. And the market can function fine with a 4.5% 10-year yield. That's okay, right? As long as the economy continues to be robust, which at the moment it feels like it is, right? The economic data continues to suggest that the economy is strong. The labor market is strong. Now, do I think stocks are a little bit stretchy? Of course I do, because they haven't really retreated at all. They do need to retreat a little bit just to churn and kind of, churn it around a little bit to make sure that this most recent move higher, this ongoing move higher that we've seen since last year, it just hasn't stopped. So I fully expect that, I wouldn't be surprised that I actually want to see the market back off because it should, but Am I bullish on America? Am I bullish on the market? Yes, I am.
Well, I think, our economy continues to expand, right? Yes. And when you're worried about inflation, it's usually a healthy sign. It usually means that you've got demand and you're thinking about supply and you're thinking about what's driving prices higher. Now, you can get these COVID disruptions, you can get supply chain disruptions and things like that are temporary. Right now, look, ladies and gentlemen, the price of eggs at the supermarket is a supply chain disruption. Right. Those are price hikes. That's not organic inflation from Correct. Everybody having to go out and pay. The price of eggs hasn't doubled. I mean, it has doubled, but it hasn't been anything other than a supply. We got bird flu out there. They've had to kill a lot of chickens, so they're not laying eggs. Here's the good news. A chicken grows really quickly. And they'll be laying eggs in 3 months, and that'll go away. The other issue is, and I worry about this, Kenny, with tariffs. I'd like to know what your opinion is. Once you take the price of something up, like eggs, to $8 a dozen, and let's say they were $3 a dozen or $3.50 a dozen before all of this started, and not all of them are $8 a dozen, folks. That's the extreme. I know that, but they don't typically go back. Once you push the bounds of that price elasticity, a certain amount of those higher prices remain sticky. Eggs might drop back to $4.50 a dozen. They might drop back to $5 a dozen, but typically they don't go all the way back. And the same thing with other price hikes. once you get those prices up 20%, yeah, the pullback might get you back 10%, but you're still going to be a good deal higher than you were. You agree with that or no?
No, I absolutely agree with that. The only way that you're going to see prices actually come way back down is if we go into a deflationary spiral, right? Like a tough recession. Then you'll see prices come back down. But if the economy remains robust, then yeah, you'll see some pullback on the prices, but you're not going to get the 100% pullback that we saw. So I'm completely in that camp with you.
Tomorrow I'm giving a speech at the World Economic Forum, the YPO, with Wilbur Ross. Wilbur Ross speaks first, then I speak, then some other guy speaks third. I actually don't even know who's speaking third. Sorry, other guy, if you're listening. Sorry, other guy, if you're listening.
Michael, it's me. I'm speaking after you.
Oh, perfect. God, you are the one person I would hate to have follow me. Most anybody can follow me, and I feel sorry for them. You follow me, I feel sorry for you. Okay. Geez. I feel sorry for me. Geez. One of the things that I'm going to say is that I was wrong for the past 3 or 4 years in my expectations of a recession. Right. That all of the data, all of those historical things from a yield curve inversion to blah, 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 and the Fed reverses policy on rates and blah, blah, blah. Every one of those times, 80, 90% says you're going into recession. Well, we didn't, which means the Fed threaded the needle of that 10 to 15% possibility to avoid recession so far. So far, Kenny, so far. So I have been wrong, and I'm perfectly happy to tell you why I've been wrong. What do you think about this knife's edge on which the Fed and the U.S. economy continue to traverse with interest rates, tariffs, all of these other things going on? What's the risk of recession now?
Well, listen, there's always a risk of a recession, right? The economy, the bull market lasts too long. At some point, it has to take a break. But I will say, to your point, I agree with you, because I actually always thought there was going to be a recession too. Remember, once the yield curve inverted, it was supposed to happen within 16 or 18 months, and it never happened, right? So they managed to prevent it from happening. Now, the economy is still strong, so I'm also, at this point, not expecting a recession at all. If the data starts to change, then I'd say, okay, we'll have to have another conversation. But I actually think the Fed has done a decent job kind of maneuvering it. I think they were a little bit aggressive last fall. I think they were too aggressive last fall, but, I guess we'll see. But I think they're right now when yesterday's minutes came out, they said they're going to leave rates alone. There's no reason to cut them yet. They are worried about a little bit of stubborn inflation. So I think that they've done a good job. There are other people that might disagree with me, but I actually think that they've done a good job.
I think they've done a very good job, and I think that their rate hikes that were so fast last fall were appropriate.
The rate cuts.
Huh?
The rate cuts.
No. I mean, the rate hikes. I'm going up to the 5 rate hikes that were so fast. You said rate cuts? Oh, I don't think we needed the rate cuts probably at all. But
right.
Yeah.
Right.
Is that what you said?
Yeah.
Fine. Okay. Yeah. So the Fed got it. So you and I agree that the Fed pretty much got it right. Their timing was a little off. They didn't get they thought that it was going to be temporary for the supply chain inflation and it would go away, and they got the timing of that wrong. It did. When the supply chain freed up, the prices on that stuff, it did go away. It was just longer than they thought. Anyway, the balance is pretty good. But I'm going back to your point, because what we're suggesting is that inflation is sticky. Shelter costs, and we're talking about rent and home prices and things, ladies and gentlemen, those are sticky. They go up. People don't go back and cut rents unless you have one of these recessions and you get a downward spiral. So when Kenny said that, my next question was, hey, do you think we're going to have a recession? Because we haven't had one in forever, and it doesn't seem to be on the horizon now. Kenny says, no, it's not on the horizon. Therefore, ladies and gentlemen, it doesn't look like you're going to see prices come down. You want to know the good news? The good news is that wages are now outpacing, over the last 5 years, are outpacing. That growth has been higher than the rate of inflation. Okay? So the average American on an hourly wage is able to afford slightly more stuff than they were as before all of this started. Your quality of life hasn't dropped. You're not suffering. Your prices are higher, but your paycheck's higher. There's 4% unemployment. Most of Americans have jobs. This doesn't look awful to me at all, but I don't see it. I don't see these higher prices coming down, Kenny's my final point, and we got to go.
Well, yeah, and I don't see them coming down much, to your point. If they back off a little bit, fine, but they're not going to retrace the move that they've had on the way up.
Right? Final advice to Fred and Ethel, please, Kenny, as we always do.
We always do. I think Fred and Ethel just have to maintain the plan, right? They've got to talk to their advisors. They got to get comfortable. They got to understand where they are in the life cycle and what they own. But I think for the most part, Fred and Ethel should not be making any major emotional decisions around, because there's a lot of headlines, right? Whether they're geopolitical, whether they're inflation, whether it's the Fed. So there are a lot of headlines that are coming in. Trust your advisor, have that conversation, and know that you're in good hands.
And I did that yesterday. I did it yesterday with my son. My son Robert works in our business, and I talk about everything with my son Robert. All of my business transactions. The kid is just I say kid. He's 32, but he's so damn smart, and his judgment is solid as a rock. He's just
he's got you as a father. Come
in spite of that, Kenny, he's good. In spite of that, he's good. But I looked at it, and I've got about a 70-30 portfolio, and most of that 30, believe it or not, is money market. I've got very, very few bonds.
Right.
And some people would say, well, at your age, Farr, that's okay, or it's still a little aggressive. And if you add in my private equity and stuff, then it's a lower percentage of cash and fixed because I've got a good chunk of that stuff. But it's where I am, and it's okay. But I review it, and I review it with somebody else.
Right.
You've got to say it out loud to somebody else.
Right.
If you start a new diet and workout routine at the beginning of the year that requires discipline, tell somebody else and have a regular check-in and tell them how you're doing. Because if you're not accountable and if you don't measure it, you're going to lose it. All right?
100%.
Kenny Polcari, Chief Market Strategist at Slaystone, voice and face of Fox Business Television. Move out of the way, Maria. Coming up, thank you, Kenny. Mahaffee, stay with us.
You can hear the sound of surf guitar, which means that it's time to go to Chicago, surf capital USA, and our good friend Dan Mahaffee. Now here's your host, Michael Farr.
Welcome back to the FarrCast. I'm Michael Farr. Joining me right now, Dan Mahaffee, who is the president of the Dr. Scholl Foundation. He is a scholar at the Center for the Study of the Presidency and Congress and the senior political analyst on the FarrCast. Welcome back, Dan.
Thank you, Michael. Great as always to be talking with you.
It is great to have you here, Dan. Dan, I can't remember ever being barraged by so many headlines, political headlines at once. And they're happening so quickly, I'm beginning to forget some of the more important ones. We talked 2 weeks ago about Panama. Nobody's talking about Panama anymore. We're now back with Ukraine. We're not really hearing much about Gaza. We were going after China. We've got a budget deal coming up. We've got the Kennedy Center board that's been taken over, and concerts are canceling left and right on the cultural front. I've got the president talking now about Zelensky and the Ukraine having started a war, and it's really a lot to keep up with. How do you focus and how do you keep up with what's going on? And what about those tariffs? Because the Fed minutes say that they're watching these tariffs closely as to what they're going to have to do with monetary policy to continue their battle against inflation.
No, those where to start, Michael? Where to start, indeed. And I think you talk about this flurry of activity and almost a fog of war, as it were, on where we stand with some of these decisions. Will they, won't they? And in some ways, a fatigue that has us numbed in ways to the noise and in letting the broader trends go on. I think you have Ukraine, where the shift you've seen in European attitudes towards the United States. We talked about Canadian attitudes. We all see the headlines, of course, how Trump is disrupting these relationships, but the shift in attitudes back towards us and how these other countries look to move on, perhaps without us. That's the reality overseas that we see unfolding. Here at home, you have, you talk about from the Kennedy Center to the grants to other things like that. You have these culture war items that certainly provide fodder to the supporters of the president. And then ultimately, you opened with the example of Panama, which I think is the, let's take that one case into microcosm, but it is sort of the guideline to if you're a foreign country or an American company or anything right now. Look, there was the pressure, the rhetorical pressure from the Trump administration. It was one of the first stops for Secretary of State Rubio when he went down there. There were back and forths, and frankly, you haven't heard much about Panama. And the reasons why are as follows. One, Panama has agreed to take deportees from the United States, even those from third countries. So they've done that part of the deal. And two, they opened the books. They're auditing the Chinese and Hong Kong port companies that are there. So look, Panama is one example of you ride out the pressure, you grant some concessions, and then you let the attention turn elsewhere, while the pressure, of the White House to accomplish things early on, they want to get them done, understandably, but ride it out while the attention goes elsewhere.
I'm going to quote a quick article about Ukraine written by David Ignatius. Now, David Ignatius writes mostly for the Washington Post, but he has a syndicated column as well. David Ignatius is left-leaning, and I've known David Ignatius for, 35 years, maybe 40, I don't know, long time. One of the nicest guys you ever want to meet, truly, and brilliant and thoughtful, whether you agree with him or not. Look, you might not like what George Will has to say. If you are leftward leaning and George is rightward leaning, you might say, I hate George Will. Well, good, but you can't say he's stupid, okay?
And if I may
say
quickly
George-
add, for both of them, regardless of their politics, George Will and David Ignatius, good examples of people who are so plugged in Washington.
Yes.
Networks and contacts of every agency, official, and ilk.
And you know what those two guys can do that few Americans can do on either side of issues? They can sit down and talk with each other for hours intelligently. They can argue. They will get along. They will agree to disagree. And they will both learn something from the other during those conversations and do it gladly and happily without any venom, without any real resentment, and say, well, this is a really bright guy, but I just happen to disagree with him, and walk away, and they'll schedule lunch for next week. I mean, they're those kind of guys. Anyway, Ignatius's column, and this is the leftward leaning, but he's an international expert. He really is, and he's connected, and he pays attention on the world. President Trump said this about President Zelensky. They said he is a dictator without elections who, quotes, had better move fast or he's not going to have a country. Now, he writes, meaning Ignatius, the president has effectively made Zelensky his adversary and implicitly moved toward an open embrace of Russia's anti-Zelensky line. His words are also likely to leave deep scars in Ukraine. One retired U.S. Army officer who's working in Kyiv sent me an anguished message on Wednesday. What the hell is happening in America? From here, we look like we've lost our minds. We're not just losing our standing with current leaders, but we're losing the next generation who are watching and learning that America cannot be trusted. Because to them, this looks like a huge reversal of U.S. policy, of U.S. words, of U.S. intentions. This sort of bombast that really, as I said, may be effective for the Trump administration in actually getting stuff done and may lead to some sort of positive conclusion in Ukraine, still strikes so many as deeply offensive and concerning. And I got to tell you, I feel a little bit like that general. If I were in Ukraine seeing this come, and all of a sudden Zelensky is a dictator without an election, he's still got a 50% approval rating in Ukraine. I mean, I don't understand this.
Sure.
Can you explain it? And what does it mean? And will it be effective?
Look, I doubt that this will be effective. And look, if I'm proven wrong that this brings peace, and that, perhaps this was a fit of pique back and forth between Zelensky and Trump, and, that would be the only best case scenario I can think of why the president of the United States would parrot Kremlin propaganda line for line. That's if this is some part of a negotiating gambit and I'm proven wrong about it. But look, you see, Secretary of State Rubio, an accomplished politician in his own right and a strong geopolitical thinker, but he's sitting across the table there with at least 50 plus years of Russian and Soviet diplomatic expertise, which would know how to just draw out these negotiations longer and longer. The history of Vietnam, and think of the Paris peace talks, lessons from history, would show just how long this can go on while the war continues. And for Putin, as we see, the rhetoric is to get the economic uh, shackles taken off as part of these negotiations without really conceding anything on the battlefield. That's the best case scenario for the Russians, and you see that reflected in their rhetoric and their goals too of keeping the United States and Europe divided. And Trump's rhetoric right now definitely helps with that.
Okay, as I'm seeing this, though, Dan, and please tell me if I've got it right or wrong or whatever, but if the United States says, hey, Zelensky, we're not your friend, you're going to be at a zero, and we're going to let Russia run in, or you can kind of do things our way, and agree to all of this, and we're going to put an end to the fighting tomorrow. You're going to agree to it because you don't have a choice, because we're out of there with all of our weapons and support. You can't negotiate without us. Therefore, the threat of our leaving is going to make you accept a deal that you don't want to accept. It's going to make Russia happy or not happy, but it's going to bring an end to this war, and I'm going to declare myself as the peacemaker of the century and get my Nobel Prize.
Right. Ultimately, if this is part of a negotiating gambit to get this war to an end and quickly, then I'll be proven wrong, and there was the best case scenario for him speaking that way. What I worry, though, is that you've given up the moral high ground as well as the rhetorical one, as long as well with a lot of other things, the cards that could be held as we go into these negotiations. We've given up a lot at the outset.
As you look around the world, is the world getting used to the new United States under President Trump? Will they ever get used to it? We've seen some of this before, but this seems like Trump 45 on steroids.
Is it Trump 45 on steroids? One sense, yes. Is it ultimately, though, the recognition of some limits of American power and our political willingness to uphold the norms and system that was created? In the near term, you could say this is more of Trump 45. Others around the world would say this is just the culmination of a long arc that started in Saigon, went through Tehran, Baghdad, Kabul, and now Kiev.
Do you agree with that? You're an awfully smart guy, and I hear from our listeners regularly that they think you're a very smart, thoughtful guy. Many tune into the FarrCast every week just to hear you, and I'm grateful for that because I learn something from you usually every week too. Not every week, but most weeks, Mahaffee. I really do. Tell us what you think.
Well, look, I think it is reflecting Trump is that there is a change in the system of the world coming about. The balances of the Cold War, the post Cold War, none of those things aligned. I think it's awfully cynical to think of it as I described, but it is what you can hear now when people are saying that the U.S. power is diminishing and U.S. power is declining. I think what concerns me most, at least with Trump, is that while there is the recognition of how to use power and using economic and diplomatic and military power together, there is not a optimistic or positive message or vision of what America and its role in the world is to complement that. And that's what I worry about, is that the cynicism and return to spheres of influence and old world politics, all that does is disrupt the system of economic and political certainty that have allowed us to prosper and grow. So you lose the seed corn, as it were, when you're focused on these self-defeating internal fights that have no vision of what America can be for the world.
And to that point, Dan, I mentioned that George Will and David Ignatius, with different opinions, can sit down and talk rationally, reasonably, and learn from each other. Uh, is that possible in Washington anymore or in America anymore? Is it permissible for a Democrat to say that they like any one thing that President Trump is doing?
Yeah.
Is it permissible for a Republican to disagree with any one thing that President Trump is doing? And if neither one side can't say anything good and the other side can't say anything bad, how do you really move forward in a reasonably thoughtful, critical way?
Well, it's difficult, and those conversations we talk about, they happen behind closed doors. But as our regular listeners know and subscribe to my professional wrestling theory of American politics, you can't break the kayfabe of talking to each other. You have to constantly be fighting. Baby face can never talk to heel, and vice versa. So if we have that attitude towards our politics, no, we don't expect them to get along, and we want them to continue fighting, because that's what they also sell us. They don't sell us a positive agenda. They're just telling us what they're stopping from the other guy.
I'm so delighted to be able to tell you and our audience I have no idea who Babyface and Heel are, and I have no intention of learning, but I have every intention of continuing to listen to you. Thank you so much for being on the FarrCast again this week. Coming up, Jenny Harrington, a FarrCast fan fave, one of the most thoughtful, brightest human beings on Wall Street. Buckle up, she's up next. Please stay with us.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back to the FarrCast, a FarrCast fan favorite. A treat, ladies and gentlemen. My great friend, Jenny Harrington from Gilman Hill Asset Management, CNBC contributor, thoughtful, intelligent, all of those things. MBA from Columbia University, Hollins University, cum laude, Phi Beta Kappa. She ain't stupid, folks. Welcome back, Jenny. We're glad you're here.
You make me sound so much smarter than I really am. Thank you for that.
No, I really don't. And I know, ladies and gentlemen, that you agree that she is that smart. She is that smart. Jenny, we started with Polcari this morning, and I said markets made a new high this week. And despite the wall of worry, stocks are going up. The economy's expanding. The Fed is moving to the sidelines because they're worried about inflation. There's uncertainty about the effect of tariffs. All of these things. And investors are trying to process it all with all of the other headlines about Panama and Ukraine and Hamas and a budget, debt cap, debt ceiling coming up that Congress is going to have to face. The president's taking over the Kennedy Center board. I mean, how do you know which headline to listen to? And if you're an investor, how do you possibly squelch out all of that noise and stick to an investment discipline and make investment decisions?
It's awfully hard, isn't it?
God, it drives me crazy.
It drives me crazy too. There's that famous John Maynard Keynes quote that says the market can stay irrational longer than you can stay solvent. So I
Yes.
have my own spin on that, which is the market can stay irrational longer than I can stay sane.
Yes, I feel the same way. I feel
Yeah,
the same way.
I'm not insane yet, but the market's pushing me as hard as it ever has to go there.
It's one of those things, Jenny, where I truly I looked up over the weekend and I said, "Holy crap! Not the Kennedy Center. On top of everything else, he's going after he's got to go after the Kennedy Center. I mean, give me a break. What? I mean, just was like the one thing I didn't. For whether you agree with it or whether you don't agree with it, really, you got to go for the Kennedy Center of the Performing Arts. The Kennedy Center of the Performing Arts. Sorry.
Maybe it's because I don't live in DC, so I wasn't so sensitive to that. To me, it was the Ukraine thing yesterday where I was like, whoa, it feels like things have gone really too far. I've had a compounding amount of clients starting to call and saying, I am really scared. Can we talk? To the point that I just scheduled for next Wednesday an interim quarterly client call. The last time I did an interim quarterly client call, because I couldn't keep up with it, was like, guess when? Want to take a guess?
It was right during the beginning of COVID and the shutdown
Correct.
of the government.
Correct.
Yeah,
last
because
time,
I did too. We all had to do that, right?
right. And
That's a good, hey, Harry, that's a good idea. We need to schedule, Jenny, I'm giving a presentation tomorrow in Miami at the YPO World Economic Summit. Wilbur Ross and I are speaking together at this summit tomorrow. And part of that is what's going on in Washington. I was there. I saw a whole lot of senators and a whole lot of folks and had conversations. We need to do that, Harry. Okay, Jenny, sorry.
no problem. So where I am is it's too much to do everyone, and spend good quality time.
Yep.
It's too much to do everyone at this point. And so I said to my team, I'm like, look, guys, we need to schedule a call. And I've got it a little scripted out already. By the way, we're not going to use any slides because those can get us in trouble, right? And what I found, actually what my husband's been saying is that right now, any comment that I make about investing and politics is basically a Rorschach test on who's listening.
Yes.
And depending on what side you're on, you think I'm on the other side.
I get that all the time. People send me notes. The problem with you damn Democrats is, or the problem with you damn Republicans is. I get both all the time, which tells me I'm probably in the right place. But Jenny, I have to, like you do, I get calls, and I'm getting them from my Democratic or more liberal clients who are saying, I am scared, I am worried, these are all of my worst fears coming to pass, and I'm ready to leave the country. And then I get calls from Republican clients, conservative clients who are saying, I love Trump, he's doing everything he said, they're crowing, and this is going to show those DEI liberals that they need to sit down and shut up. And I listen to both, and my job is not to agree or disagree with anybody on those points, because none of them have anything to do with investing, or they have a lot to do with investing. Depends what I have to say. But I have to be able to counsel those people through their long-term investments through this period in U.S. history. And it's a hell of a job to try and meet these people in their emotional moments and bring them back to a factual center that deals with their net worth and long-term well-being.
Right.
I know you've got a lot of it. How do you do it?
So I don't know if I'll be successful or not, but this is how I'm planning to do this next week. And what I'm planning on next week is just an evolution of the 5 or 6 conversations that I've had already this week. So I'm going to start this client call off, and I'm very seriously going to do the following. I'm going to say, and I've got it typed up right here so I don't screw it up. Raise your right hand and swear that you will not assign partisan inference to what we are about to say. We are being entirely apolitical, but we'll talk about the portfolios and also how current and domestic politics may affect them. But it's interesting. Like I was on CNBC a couple weeks ago, and Scott Wapner was pushing us to say, what are you reading in the room? And I'm like, I'm reading chaos. I'm reading chaos as ahead. And frankly, as a portfolio manager, sometimes chaos ahead is a lovely thing because it creates opportunity. Someone called into my office and said I could tell from her face that she hates President Trump and she'd better watch herself. Like, that's insane, right? That's insane to make that inference. So I'm making my clients, if they want to participate in the call, swear to God that they will not assign political inference. Because I am speaking apolitically and I'm looking at this and thinking about the market. And then this is what I'm going to get into. I'm going to tell people, because I had one call about this yesterday. So far, we are not hearing from any insiders about moving money, insiders being like the smart money or the smart people or whatever, about moving money, about moving cash overseas. So far, we are not hearing from any insiders or smart money about moving their homes overseas. In our quarterly call, we fleshed out what we thought the worst of tariffs could be to GDP. And we still stand by those expectations, which is, the kind of likely case, worst case downside on GDP from tariffs would be about 0.5%. Right. The worst case would be about 2.7%. Each tariff that we've seen so far, it just gets, reversed anyway. And now Europe's coming to the bargaining table and blah, blah, blah. But to me, I'm like, the worst case from an economic impact on tariffs right now is about 0.5%. And one of the things that I love about this job is it makes you actually go in and look at where tariffs used to be, where they are now, what goods they're assigned to. Okay. And then I'm going to go on to say what we are talking about now, what we're thinking about now as it impacts portfolios, are mass layoffs of government employees. And like, what does that do? If that really negatively impacts consumer sentiment because millions of people are losing their jobs and they're feeling dislocated and disjointed and disoriented, why wouldn't that take a couple multiple points out of the S&P's rich 21 times multiple? Or if millions of people are suddenly unemployed, why wouldn't that impact consumer spending? And what's hard about this right now is, are those job cuts permanent, or are most of them being brought back in 2 weeks or 90 days? We don't know yet. And then there's the question of like, is there a chance that government debt levels really are reduced? Because frankly, over the past 5 years, my biggest concern about the U.S. has been our debt burden. That is really, truly scary. Like that is truly an existential threat to the United States' strength and growth. And if any part of this actually can reduce that, like that's a tiny little silver lining. And then what I'm going to conclude with, and I'll be more robust on this, but what I'm going to conclude with is, what do we do in times of turmoil? And what my partner Greg, he's so wonderful, what he always says is, like, what do we do? What do we do during the pandemic? What do we do during October 2018 to December? He goes, we follow the process. We follow the process. When we don't know which end is up, we follow the process. And here's what the process is, and it always will be, and it always has been. You look at each company in the portfolio, and you assess its future. You don't try and market time, because inevitably, even during the pandemic, like you end up getting screwed by trying to market time. So if you have a portfolio that's going to work, you keep legging in. You stay invested. You don't act emotionally. You research your stocks. You assess their future prospects. And it's very, very hard to do when the noise is out there. I don't know if you guys follow this guy, Adam Crisafulli from Vital Knowledge.
You've mentioned him before.
He's the best. But he was saying last week, he said, I think the noise to news ratio right now is 100 to 1.
It feels that way, doesn't it?
It sure does. And I think one of our jobs is to act like a sieve, and shake it out, shake it out, shake it out. And there's so much noise. I think there's more noise now than almost any point I can remember in my investment career. Like even the pandemic, there was so much noise there, but it somehow seemed more one note noise, where this is broad and wide and crazy. I'm probably just misremembering how bad the pandemic was. But it's our job to sift out the noise. And that's the struggle that we're in right now. We actually have a quite robust economy. We have corporate earnings that are continuing to grow. We have interest rates that are still more likely to go down than up. And so despite all the noise, the backdrop for U.S. equities, somehow, presuming consumer spending doesn't fall off a cliff and presuming consumer sentiment doesn't just completely implode, somehow, the outlook for equities remains reasonably stable, which
for over 35 years, my one tagline has been that emotion is the foe of the long-term investor. Also, of course, that you can't market time, and that it is through a dispassionate, dogged approach to your discipline that you will survive long-term as an investor. But ladies and gentlemen, I want you to think just a little bit, if you had to do what Jenny and I have to do. Now, granted, we put ourselves in this public position, but I got to stand up tomorrow in front of several hundred people tomorrow, and I've got to talk about tariffs, the reduced immigration, the number of evictions from this country, the unfunded tax cuts that are only going to add to our debt and deficits, and the political pressure on the Fed to simultaneously to reduce interest rates. And I've got to convince those few hundred people that I'm not being political as I discuss those things. And I've got to be able to talk about those things relative to the economy and the markets without pissing off most of the room.
I'm going to send you my line.
Huh?
I'll send you my line, and you can make them all raise their right hand and swear to God that they will not put political inference on what you're saying. Make them do it.
Sure. Yeah. And you think they're going to do it? Because I start my speech every year for the past like 6 or 7 years. Please turn off your political ears. I've got to talk economics. Immigration's an economic issue. Productivity's an economic issue. Taxes are an economic issue. Just quit throwing rocks at me, would you please? I got to get to this stuff. And people sit there and they'll go, okay, we know we should do that. And then all of a sudden, I'm 4 minutes later and I see people starting to steam, and I think, all right. And I look at them and I go, hey, I see you starting to steam. Stop it. You got to come back to center. And then when I get too deep in some of the wonky economic stuff, I'll say, I see your eyes glazing over. Hang with me for just 1 second. One more second. Stop with the eye glaze. Focus here. I'm going to be done in 30 seconds. Promise. Jenny and I, by the way, sit on the board of an institution with well over $1 billion in assets under management. She and I are the co-chairs of this committee on this board. And we have a discipline, and we have some amazingly talented, largely thanks to Jenny, investment professionals with a lot of experience. Jenny, would you just try to give some color to our listeners about how this committee approaches market volatility, political news? Interest rates are going to do this, oils are going to do that, and we work with a consultant. And would you just explain how we do it when we have to do it professionally?
I will, but I'm going to give you all the credit on that.
No, I wish you wouldn't.
But it's true because you've been on that committee longer than I have, right? And so Michael, through his leadership, has kept the ship on a very, very steady forward, like we don't screw around course. I think how we do that is interesting. So Michael gave an example on our last committee call, how he was speaking to someone else, and they said, "Hey, given that the market's up right now, shouldn't we be putting some cash aside? Shouldn't we be taking some off the table?" And Michael responded, the reason we've had these superior investment returns over so long is because we don't ask that question. And I might be paraphrasing incorrectly, so jump in. But we don't ask that question. We set a course, we keep our eye on the horizon, and we do not stray from the eye on the horizon. And what that is an allocated portfolio, some fixed income, some equities, well balanced between each. When an equity manager underperforms for a long time and there's like a serious change, like we consider replacing them, but we give everything a long-term, very patient, very thorough, very thoughtful, what's the right word? Like leash, right? To do what we hired them for. And we do not let behavior impact our thinking. We do not succumb to market fluctuations. I think the bottom line is because this investment committee is such a steady, philosophically aligned professional group, we have superb and superior investment behavior, which is very hard. I'm going to jump aside for 1 sec, but it goes on to investment behavior. I actually taught or co-taught, whatever, guest taught a class at Baruch College last night. It's taught by my friend Yves Siegel, who some of you may remember. He was kind of the original MLP the MLP analyst way back at Wells Fargo in the day. And he's really just an impressive investor, an impressive person. He teaches a behavioral investing class at Baruch for their graduate program. And what I did was I asked all of the students to please send me their favorite investment quotes. And then I put them up on the screen. And I'll read you some of the others. This one's, you'll probably have heard some of these, but there's things like Warren Buffett's, be fearful when others are greedy, be greedy when others are fearful. Ben Graham's, successful investing is about managing risk, not about avoiding it. Here's another good one. Charlie Munger, a lot of people with high IQs are terrible investors because they've got terrible temperaments. Here's the John Maynard Keynes one I already said. Let's see. This is John Templeton. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. And I asked the class, I said, okay, of all the brilliant investment quotes you sent me, right, all the best investors, the people who've made billions of dollars by investing, what's the common theme? And I was surprised both last year when I did this class and this year, like it took them 1,000 tries to get it. But I'll tell you what the theme isn't. You can read all the best investment quotes and not one person tells you how to pick a stock. Not one person tells you how to set the asset allocation for your portfolio. Not one person tells you what level of risk you should take. No one says venture capital investing is the way to go. No one says private equity. Every single brilliant investment quote, the best advice they can give you is about behavior and about behaving well, and staying true and steady and not letting the noise impact you. And I think, Michael, that's what we do well. We manifest that collective wisdom on this investment committee. We behave well.
Ladies and gentlemen, that's my friend Jenny Harrington from Gilman Hill, and now you know why we have her on. And now you know why you should make sure you take it off of mute whenever you see her on CNBC. This woman is worth listening to. I promise. Take a couple notes. Think about what she said later today. I'm certainly going to do that myself. That's it for another FarrCast as we cover Wall Street, Washington, and the world as we bring you insiders to help us better understand what's going on in all of those places so that we can figure out our worlds better and stick with our investment disciplines despite all of the noise. Ladies and gentlemen, the Republic will survive. I promise. I promise. If I'm wrong, come back and talk to me. But I'll stick with that one for a while. The Republic will survive. We'll get through, and we'll be at better, happier shores in the future. The seas might become rough. That happens at times, but we will get through. If we can help you at Farr Miller and Washington, or Jenny can help you at Gilman Hill, or Kenny Polcari can help you, find your professional advisor out there. That's kind of what we do, and everybody needs a little help. Everybody needs somebody to talk to, as one of my good friends says. All right. Wait a minute. Jenny's waving at me.
I'm jumping out of my seat. Okay, one more thing. Find some professional help. One of the students in the class last night said to me, Michael, isn't it true? Because I read a study that shows that people with a professional financial advisor, on average, have a 3% better annualized return than those who don't. And I said, I haven't seen that study, but I'd like to. But it makes complete sense to me. Because when you're not acting alone and you have a sounding board and you have professional advice, you know what you're likely to do? Behave better. Which my guess is that does add 3%.
There was a study years ago by Massachusetts Financial Services, and it was terrific, and it was so stupid, but I was surprised at the result. They looked at mutual funds that had a 3% load, and they compared them to similar mutual funds that were no-load funds. And the no-load funds had better returns than those with the 3% load. Shocking, shocking. But here's the real shocking part. The investors who bought the 3% load funds had better results than those who bought the no-load funds. Why? Because they'd paid the 3% and they weren't going to sell them. They stayed with them longer than the people who had the no-load funds, and therefore their results long-term were better because they didn't get in and out. That's what we keep saying. We keep finding different ways to explain it best as we can, but I've done this for 37 or 38 years, folks, professionally, every day, full time. You don't have to agree with me, but I hope you don't think I'm particularly stupid. I've learned a lot of hard lessons over those years, and I listen to smart people like Jenny Harrington. We're going to be back again next week doing Wall Street, Washington, the world for Harry Jennings, our producer, everybody at Hightower and Farr Miller in Washington. Thanks for listening. I'll be back again next week in Naples, Florida. I'm Michael Farr.
And that's a wrap on this week's episode of the FarrCast. Thanks to our guest, Kenny Polcari, Dan Mahaffee, and special guest from Gilman Hill, Jenny Harrington. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And if we can be of assistance at Farr Miller in Washington, please reach out to me at hjennings@farrmiller.com. I'll be happy to put you in touch with one of our investment professionals to help you navigate your financial course. We are grateful for all of your notes and comments, and we try to respond to as many as we can. Please keep the emails and messages coming. Take care, stay safe, stay healthy. We'll be back with you next week on the FarrCast. Wall Street, Washington, and the world. Farr, Miller & Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and a SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr, Miller & Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr, Miller & Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.